So we went through at the beginning of the year and did this presentation, a version of it that incorporated some of the themes, big things that are happening in the market, what everybody's been watching, and we're going to start with that stuff. But obviously the playbook has kind of gone out the window with the events of the past few weeks. So, AI is a big deal. It's been impacting markets. They say that it's radically changing industries. That may be the case, but it also may not be the case. Lots of folks were afraid that artificial intelligence is going to take their job. And the reality is these are the same fears that were prevalent in the 1980s when the era of the personal computer started, and they thought that was going to take all the jobs. And in fact, what it did was create many, many, many more jobs than it ever took. So it remains to be seen what the impact of artificial intelligence is, but it is increasing productivity. And that's something that's going to be necessary, particularly in the challenging market environment that we're entering into and that we're already well aware of after the past few days. Back to the office. Everybody's being called back to the office. Work from home seems to be, no longer as much of a thing, if it's been a thing at all over the past several months. And that's fueling, potentially a resurgence in people moving into the urban centers, the office towers gaining some traction again, a lot of which were under pressure for quite a while, actually. There were some distressed office properties that are now starting to look a little bit more attractive. Investors are going into those markets. We'll be watching that pretty carefully because that's a very big change. The DOGE committee that's been out there cutting expenses ostensibly, it's debatable, actually, the extent of their power to do that. I was at a seminar this morning where they were discussing how it looks like a lot of running in place and that they're probably not going to be able to get to their target. But this is something that yet remains to be seen. It is a big change. Lots of different types of government contracts are coming under scrutiny. Different departments are being culled or at least made smaller. And that's another enormous change. So I guess the theme here is there's a lot of change going on, not just tariffs. Change in general is going on. Restructuring of alliances. So this is interesting. There are a lot of folks speculating that NATO, as we know it, may not be existing in the same form by the end of the next couple of years. There are just these vast shifts of alliances. We're not really on friendly terms like we were with Europe. We're not really on friendly terms with a lot of our allies at the moment, particularly in light of these tariffs. And these are, these actions that have happened are a one-way door. It's not like you can roll back the tariffs and say, oh, well, we're going to go back to normal now. And you have other countries that say, well, we don't know that we can trust that it will stay that way. And so everybody's kind of moved from a unipolar world that was under our leadership to a multipolar world where you're going to see trade blocks happening. And this sounds like something radical that I'm saying, but in the academic world, papers have been written about this since probably the early aughts. And the academy has been talking about, this strategic bifurcation, which might be my next slide. Oh yeah, here's a quote from Churchill. Those who, fail to learn from history are doomed to repeat it. The way that the world changed in the past few weeks, yes, there was a long on-ramp onto this point. So we all knew it was coming. We knew the tariffs were coming. We knew that trade alliances were fracturing. But the reality is we haven't seen a change of this magnitude or importance since the mid-1940s in the post-World War II era. So, there are folks out there in the analyst community and in the television host community who are talking about, well, things are going to calm down and go back to normal. But again, what we see is these things were actually a one-way door. We're in a new normal, and we have yet to figure that out, which is probably why the markets have been so turbulent. And I use that word probably. No one is in a position to tell you that they know that. Anyone that is saying, oh, we know why this is happening, the markets are turbulent, is at best being disingenuous and at worst misleading. So, take it with a grain of salt. We're all in uncharted territory. There is probably not a single market practitioner alive in this business that has witnessed this type of change or traded through it. That's why, without anybody knowing what's going on, you see these swings, 1,200 points in the Dow, up, down. We've been up the past couple days. Feels good. But I wouldn't get too comfortable with it. We're going to see these turbulent big waves probably for a good while until we figure out what this good normal, this new normal is going to look like. The strategic bifurcation that I had mentioned earlier, the world has shifted. We've got our group, the United States, as a trade bloc with whoever is going to negotiate with us. Europe is forming its own. The Asian community is forming its own. And we're going to just see a new reality, and there's a lot more frictions with regard to international trade. That has big implications. We're going to talk about that stuff later. All of this stuff I'm talking about sounds a little bit scary and unnerving, but don't get me wrong. This is a profound time of opportunity, and this is a very interesting time to be in the markets, to be invested, and to be a part of this history that's unfolding. So mercantilism is a term that many of you probably are going to groan and say, well, that was a topic I didn't really care too much about in history class. This was in the 17th and 18th and 19th century, where countries were all in this same go it alone, it's every man for himself or every woman for herself type of an environment. That's exactly what we've gone back to. And instead of this liberal world economic order, when I say that, I don't mean politically liberal. I mean in terms of freedom of trade. We want trade to be, as low barrier as possible. That's the liberal trade order. That's gone. And so instead of it being in everyone's interest to cooperate, it's in our interest to hold close to the vest everything that's important. And, it's just a profoundly different paradigm that we're in. And we need to recognize that as investors and respond to that appropriately. The way to respond to that is not by making a knee-jerk reaction and saying the market went down 1,200 points, so I better sell my stocks. No, it's just be aware that the world's changed, and what is the opportunity set under those conditions, which I'll talk about a little bit more. But economic relations are being, changed from being collaborative to confliction. You've got, the state is the important actor versus individual companies being the important actor. A lot of profound change in the way that, people are thinking about business. So let's look at some historical perspectives. And I drew this slide up, or this next series of slides, precisely to kind of calm everybody down. Now, these don't look great for calming you down, but I want to provide some context because last week, markets were really frightening. And we got a lot of calls. Everybody got a lot of calls. We've been through this before. So 1907, there was a great panic. The entire financial system almost collapsed. During that particular time period, J.P. Morgan of the J.P. Morgan firm fame actually strode down onto the floor of the stock exchange and personally guaranteed that all of the trades would settle. And they were afraid that the whole exchange was going to collapse. And by this guy going down there and personally guaranteeing it, things were going to be okay. They wound up being okay. That was how intense it was back then. You saw drops first of 22%. First it was actually 16%. Then a short time later, 22%. Then a short time later, 34%. But it came back and recovered all within a few years. And this is the silver lining. We've seen these great drops. And we get a little nervous. Should I sell my stock? No. If anything, we want to do nothing and watch. Or if we have the ability to, when we see things firm up a little bit, take advantage of the opportunities when stocks go on sale. The longer term is much nicer. Here's 1929 and the Great Depression era. That was at 84% drop between the beginning of the Great Depression and 1929's crash. And yet, it took a long time, but markets went on to new highs. By the way, that on the Dow is 488 in the 50s. We're well more than 10 times that now, even with the drops. So the 70s, we had the same sort of thing, a 38% decline in the 70s in the 74 market, comes back, ends higher. The reason I'm bringing all of this up is it should provide comfort when we see this turbulence that there is a silver lining. It does come back. And with that, here we have the collapse of the internet bubble. It was the same sort of thing. 2008's great financial crisis. The point is, this has happened before. Here's COVID. COVID was really particularly nasty. COVID was a crisis of a whole different order. We're not talking about just trade alliances changing and the structure of the global economy. We're talking about, the entire global economy shutting down completely. Everyone was locked down. You remember that? That was a lot of fun. But here's what happened. We started getting news in February that this thing that we were hearing about was maybe more serious than what we had thought. And, maybe there's going to be some lockdowns in Italy. Maybe there's some lockdowns in China, and it's going to spread. All of a sudden, it's getting worse and worse, precisely because no one knew what was going to happen. And I want to highlight, look at these big down days and big up days, big down days and big up days, kind of like what's been happening this week. And it's because the market doesn't know what's going to happen in the new trade regime. But as soon as the news starts coming in, even if it's bad news, the market's going to have a lot less uncertainty. It's uncertainty that causes the problem. It isn't the bad news. So once we get a clearer idea of what this world looks like, we probably are going to see a recovery, and there's a reasonable chance that it may even look like this, because a lot of the changes in the structure of trade have silver linings in them. And with that, let's get into the normal stuff that I had planned on before we went into contingency and crisis planning mode. Economic growth is running at 2.4% before all of the events of the past couple of weeks. That's actually expected to be lower now by a good margin. I was with a large investment bank strategy session today, and they were calling for about 0.5% growth for this year. Still growth, but the odds of recession are picking up. In other words, that might be negative in the near future within the next year. Is it going to be terrible if it does? Most likely not. The analyst community is thinking that if there is a recession, it's only going to take unemployment back to about 5%, which, if you remember back to economics class, the professor probably harped on the fact that 5% unemployment constitutes full employment in the economy, as at full capacity, and that if it's lower than that, the economy is actually running too hot and it's inflationary. So this wouldn't be a terrible, terrible thing. At the global level. It will be a tragedy for certain groups and certain individuals, for sure, but in the grand scheme of things of the economy, it will just be bringing us back to historical norms. The labor market has been doing very well. In fact, the last reading here that I had was February's. That said, in February there was 151,000 jobs created. Actually, in March, it was 270 or something like that. I don't recall the precise number, but the point is the labor market remains very strong. Jobs are being created, and that's profoundly good for our well-being and for the future. That's not expected to change dramatically either. Consumer sentiment has taken a dive. It's even lower than what it was, when I got this reading as of the last one. But the reality there is anything over 50 is still not considered to be terrible in terms of the consumer sentiment. Big ticket purchases. So this is the durable goods numbers. Those are actually trending up. And people are not buying things on credit, things like a new refrigerator or something like that they're doing on an installment plan, unless they're relatively comfortable about their economic prospects, which, that's another bullish sign on the economy. In other words, strength. Mortgage rates have trickled down a bit. I mean, let me go back to mortgage rates. Sorry. So this number here, when they got up near 8% recently, there was a lot of talk and a lot of people were nervous and not really liking that, thinking, wow, rates are so high. Because we've gotten spoiled with these low rates. I think at one point, 2.5 was a good rate? And now it's more like, 6.5 as of right now? That seems high. The historical average, if you go back over decades and decades, is around 7, which is in line with where we're at now. So it's not out of the norm when you look back on history. What is out of the norm is that zero interest rate environment. And to kind of come back to that topic of how the world is changing and we're no longer seeing, a lot of cooperation, that's a disinflationary factor, that cooperation. When you have all of the nations, able to specialize in what they do best and therefore engage in free trade, that keeps prices down. That keeps efficiencies up. when you have the United States or China or Europe saying, hey, we need everything to be produced in-house, that's not the most efficient way of running the market. So that's an inflationary concern, and that's likely to keep rates more in this area over the longer term, even if in the short term, because economic conditions become challenged, we may see lower rates later this year. I wouldn't bank on that being the norm going forward, though, like some of the analysts are out there talking about and saying, oh, we're going to come back to a low interest rate environment. The structure is not in place for that right now. Residential rents even came down a little bit on the last run, and that's another bonus. That's good for those who are looking for a place. So the Fed funds rate, I'm going to poke some fun at the Federal Reserve here in a few minutes. Hopefully that doesn't offend anybody. But, you know, the reality is I've overlaid federal funds rate over many, many years since the 1950s with U.S. recessions in red. Hopefully you can see that. I know the light's kind of coming from behind my display there. But you'll see that when we have this type of a pattern where rates hit their peak and then descend down, that's when the recessions tend to happen. So we are in a bit of a danger zone, and the Fed is actually potentially taking some action to lower rates in response to this current market gyration that's going on. Yeah, here you go. They don't know what to do. They didn't know what to do. Rates got very high in terms of inflation, and they began lowering rates when inflation was still high, which is kind of akin to throwing gasoline on a fire that's already going. So it keeps inflation hot. And inflation ultimately is not great for us because that means prices are rising. And in general, prices are rising faster than incomes. That's not the case right now. Right now, incomes for the past year have been rising faster than inflation. So that's okay. But if that changes, the inflation becomes kind of inhibitory toward economic growth. And they're caught between a rock and a hard place, because if they lower rates in response to a weakening economy, inflation ticks up. If they don't cut rates in response to a weakening economy, then the economy gets weaker and we go into a deeper recession. They don't have the policy tools that they traditionally have, which is why I have him here scratching his head. The Treasury yield curve. The Treasury bond is considered to be the risk-free asset. So in all of the financial models that we use, whether it's stock valuation or bond valuation, mortgage evaluation, we use the Treasury rate as the base rate to build off of. And there's only one risk with the Treasury, and that is inflation. So in other words, if I loan money to the U.S. government, it's taken as a given that they're going to pay that money back. However, it might be worth less. A dollar that I get back tomorrow might be worth less because of inflation. So that's why, inflation risk premium is the only risk premium in yields. And yields have come down dramatically since the beginning of last year. More importantly, over the last month, they've come down in a big way as well. This dotted line right here, or this gold line that I'm on right now to this line is what happened over the past month. And that means essentially in the presence of inflation, which is the only risk in yields, how are rates going down when inflation's high? It's because people are afraid. And they sell stocks, they buy bonds. That's called a flight to quality. That's why we're seeing these artificially low rates right now. And they may persist for a little while, but it's likely that those rates are going to go right back up, kind of to this level where they've been. Corporate bonds are doing a similar thing. You're getting great yields in corporate bonds. Sorry about that. 4.5%, 5%, 5.5%, 6%. For loaning money to high quality corporations. So income investors are now getting paid to take their positions in bonds. This is great for two reasons. Number one, if you're getting income off of your bond portfolio in order to spend that money or use that as actual income, that's great. That's much better than the 1% or 0.5% that was prevalent not even 3-4 years ago. However, bonds are also used to reduce volatility in portfolios. We do that a lot in ours. We want to have a mix of asset classes. We want to diversify. Stocks tend to zag when bonds are zigging, and we want that dynamic in your portfolio. It protects you from the risk. So if you're getting paid 5 or 6% to take a position that reduces your risk, this is a really good thing. And conditions like that are probably not going to change for a while. So if you've heard from others that the 60-40 portfolio is dead, which is 60% stocks, 40% bonds, actually we've entered market conditions that favor it. And they're going to favor it for the foreseeable future. So consumer inflation is the CPI, the Consumer Price Index. The last reading I show here was 2.8%, and that's high. The Fed is ostensibly trying to target 2%, and yet they're running it at 2.8, and their policies are likely to get it up higher. I heard today from some of the participants in this seminar that their target was somewhere around 4 or maybe even 5% as the inflation rate going forward. But at the same time, they're also forecasting higher incomes, which I guess we can be happy about that. Producer inflation is a different animal. So consumer inflation coming up by 2.8% is, that's the prices consumers are willing to pay. We take that as a proxy for what corporate profits are going to look like, because or corporate sales are going to look like. So if companies are able to raise their prices by 2.8%, that's considered to be revenue going up by 2.8% according to this model that I'm quoting here. If instead producer inflation is 2.1, that's good. That suggests that instead of the producer costs, the input costs of products going up higher than their ability to pass them on, corporate margins are actually strong and increasing because, the input cost prices from producers is only going up by 2.1, and it's going up by 2.8 for the pass through to consumers. So they're still, making more money per widget sold, for lack of a better way of saying that. So this is a good thing. That supports strength in the stock market, even in the face of a lot of uncertainty. Equity market volatility, and this is what happened last week. Precisely, we had this volatility index reading, which is the VIX index is what they call it. That measures protective activity that market participants are taking against downturns in the options markets and in the futures markets. And that spiked to a level that we really haven't seen since COVID or the great financial crisis. This little thing that happened last year was an anomaly. That was just a strange market condition for a few days. That was nothing major that we had on our radar. But those are major events. When volatility spikes like that, it means fear in the marketplace is very extreme. And in this case, we can see it played out in the S&P 500 as to what's been happening recently. This is the last year. And, this looked okay for a while. And then, come October, November last year, we started seeing this churn, bigger ranges. And I want to keep harping on that. When you see these big ranges between the highs and the lows, and they're up, down, up, down, up, down, that's not good. And that tends to, lead to these type of events. And this was yesterday. Or actually, though, this was taken the day before yesterday, close. And markets just dove to a level, found some support, and came back up. And then they were up again today. I don't know how much. I was out in the field today, but I know it was another big day. And, you might get excited about that and say, well, we're in the clear. But these type of events take a while. So we want to set an expectation that it's likely to be a bumpy ride throughout the summer into the fall. These are big changes that everybody's digesting. It doesn't change the value of a good long-term investment plan, though. These are short-term things. Even if it lasts for 6 months, 5 months, however, a year, that's a short-term event. We're looking at a much longer time frame. I had already kind of alluded to the next slide where they're out of ammunition. The Fed is not going to be able to do much here. However, here's the solace. The long-term view of the S&P. 2008, we thought the entire system as we know it was going to be destroyed. And I see some folks straining to see the thing back there. I apologize for that. I will make the slide deck available to anybody that's in attendance. So that looks like a blip in the long-term chart. But that was our whole system. I was trading through it, and it was a very interesting time, much like now, to be around. And then you had a storied investment bank like Lehman Brothers fail. The events were very shocking at the time. Nobody thought we were going to get through it. But again, markets went down and then they came back up. Here we have 2020, which was a catastrophe. No one knew that the world economy was ever going to function the same when it reopened. And yet we rocketed off of that. And now we have another one, and this looks big now only because it's looking at it in terms of absolute price, not the percent change. This is not a bigger magnitude drop than this. It looks bigger because it's closer into the present. If we looked at a logarithmic chart, not to get too technical, it would not look as big. But that's the solace. A good long-term investment plan is not going to change based on fear or greed. You know, not only have we talked to folks who are saying, hey, should I sell my stocks? We've also talked to those who say, hey, I want to buy more right now. We don't think we know enough yet. You know, we need to take a hands-off approach for a while, let these things equilibrate, and let everybody get a clearer idea of what the world looks like, and then start to buy stocks. But for now, the most prudent approach is stick to your plan, stay invested, and talk to your advisor, talk to the professionals that you use or that you follow in blogs or in the news. But you don't make changes to the plan, particularly when the world seems to be falling apart around you. So with that, those are my prepared remarks. I'll entertain any questions anybody has. I know that there was a lot of stuff that sounded kind of rough, but there is also a lot of opportunity and silver lining as well. So the question is, for everybody that might not have heard that, where do we see the world in 1, 3, and 5 years, you know, from the economics point of view? And it's a great question. It's also very difficult. I don't remember what coach it was that said, you know, prediction is very difficult, especially when it's about the future. But this was said, and I tend to hold to it. However, in a time when things have changed this much, 1 year probably is not enough for all of these things to be worked out. They're still going to be figuring this out. 1 year, it probably is going to just chop around for a while and not do much, would be my best guess. And then at the somewhere between 1 and 3 year period, we're going to have a very clear idea what the world looks like. And I'm going to get a little philosophical with this now. The market is a dynamic, evolving system, a lot like nature. And in nature, you know, you have this competition between species, and you know, the adaptable survive, the strong, the fast, the smart, all of that. And companies are going to find that in this environment. Those that are adaptable are going to adapt. Those that are faster than others are going to do well. Those that are smarter than others, and so on. And so what we are going to see over the longer term, 3 and beyond years, is these companies are going to outperform by a large margin their peers that don't do those things. And so to dial it back again, how does the world look different? Coming into this for decades, there has been this, lack of a better way to say it, rising tide lifts all ships type of market. And you know, that was favoring the index funds. You could own the average, you wanted to own the average, and you wanted to just ride that up. Now, that's not going to be the preferred approach. You really need to dig deeper and find out who has a competitive advantage and why, and then invest in those, which favors an active style of investment management as opposed to the factor-based or the indexing type things that have been going on. So the world's going to change pretty profoundly. If you read back into history, some of the money managers from the 70s and 80s that were more active would be probably the model that's what's going to work. That's a little self-serving. That's what we do as well. But it is true. In this type of environment, there are going to be much clearer winners and losers, and it's just going to require a little bit different of an approach. But there's still going to be opportunity, and there's always opportunity. No matter what the challenges were in all of history, we've had opportunity. We just have to be diligent in finding it, and we have to be courageous in taking advantage of it. So that's what I see. I see prosperity coming back. You know, after all of that kind of dismal stuff that we were talking about, I still see a profound period of prosperity coming as a result of all of this. You know, I think it's like everything else. It's a little both. So you have, and the question for anyone that didn't hear it was, what do we think about the tariffs, what their impacts will be? Will that be positive or negative in the long run? And it is hard to say. However, you know, on the challenges side of the ledger, things that are not great about tariffs is it slows down international trade. It makes it a lot less efficient to produce things because You're getting a tariff on parts that are then getting tariffed when they go, to the next bigger part, then they're getting tariffed again before they go into the end unit. And so prices are going up. Countries that used to have a specialty in one particular thing and were very, very good at it, now are trying to do everything. And that's not really great for efficiency-wise. But at the same time, it does create internal security within those countries. I would say also on the negative side of the ledger, it weakens traditional alliances. When you're trading partners and you are tight, you tend to, lack of a better way to say this, everybody has each other's back. Now it's a lot more dog eat dog. And that doesn't bode well from the standpoint of security in the multipolar world. Now, it also, assuming that how should I put this, productivity is able to be increased commensurately with the levels of the tariffs, and that may spur productivity increases because companies will have to increase that. That could actually be very good, and you have artificial intelligence already working to help that out. So yeah, balance, good and bad. I think the better answer is it's not going to be good or it's not going to be bad. It's just going to be different. So stagflation is something that I've warned about in my newsletters at various times over the years, particularly in light of this gentleman's policies, which seems to be coming to fruition right now. Stagflation is a term, as a definition, means you have a period that contains both a weakening economy, in other words, slowing economic growth, negative economic growth, at the same time prices are rising. And that is precisely the situation we find ourselves looking at right now. Interest rates, the Fed has already come out and said in response to this crisis, they're expecting to cut rates another 5 times from here, another 25 basis point cuts in order to get down to a level where they feel that, economic growth is balanced against the risk of inflation. We think that that's not a smart move. I don't think it's tenable. I don't think it's doable, because inflation is already running at 2.8 and even hotter. And if inflation's already running hot, how are we going to lower rates, which is essentially pouring gas on a fire? So, in this event, they can do other things. They can buy longer dated bonds and potentially influence longer interest rates, including mortgage rates, by the way, if they do that. If they're buying the 10-year Treasury, that's kind of a benchmark for mortgage rates. But at the end of the day, that's a very challenging problem, because in the event that you have rising inflation at the same time you have falling economic growth, you don't have the policy tools to manage either one of those things. And that's what happened in the 80s. 1981 was a very historic speech by a Fed governor. So the guy was Paul Volcker, and he got out there and said publicly, we are going to break the back of inflation. We're going to do whatever it takes, no matter what. And it was a pretty nasty recession that followed what they had to do, because they just went in and aggressively raised interest rates, even though they knew it was going to hurt the economy. So let's all kind of hope, or if you're inclined, let's pray that that's not the situation that we face. I'm not saying that we're going to face another deep, horrible recession like that 81, 82 recession was, but it is not a good situation, stagflation. And that is on everybody's mind now. It should have been on their mind back in 2022 when we were hearing things like, from this guy, inflation's just transitory. We're not worried about it. We don't need to hike rates. They needed to hike rates. So it was policy errors that got us here. Maybe it's policy corrections that get us out of it. All right. Well, thank you all for having me here and the team here. We're happy to be here. Before I get off the stage, I've been asked to draw your attention to the notepads on the table. And we're asking for kind of your opinions, what you would like to see. I know that I can be a decent speaker, but there are other really good topics that are going to be fun for you. We want to know and hear about what you would like to see from us, and we want to be able to provide that down the line in the future.